Well, hi, everybody. I'm Anita Ward. I'm the Chief Development Officer from Salary Finance. We're a social purpose fintech with the mission to move 10 million working Americans from debt into savings and into financial well-being. But I'm super excited because for the next 20 minutes, I get to exercise my cultural anthropology muscles and talk about people and data. And my partner for this talk is one of the smartest people I know. You're going to love to hear from him, Zoey Cole. Hi, Zoey. Welcome. Zoey is the
Thank you,
analytic.
Anita.
Oh, that's so good to have you. Zoey's the analytic partner leader from Equifax. So, he's got tons of data to share. And what we want to do with this session is really just set the stage for the rest of the afternoon. So we're going to look at some really interesting data, maybe address some of the social implications, and just challenge you to think through a data framework as you explore the rest of the sessions in this track. So, hey, Zoey, I took a peek. You probably didn't want me to, but I took a peek at your first slide. And I got to tell you, I was a little bit surprised because it shows, here we are in the middle of a global pandemic, and it shows that the net worth of the American family actually went to an all-time high in the second quarter. I mean, how is this possible? I really don't get it. So, otherwise I'm going to say, did COVID bring financial well-being? But maybe we could start there and tell us a little bit more about what you're seeing.
Yeah, sure. And I mean, quite honestly, I would say the exact same thing. It's one of those headlines that really grabs you and makes you go, wait a minute, okay, I absolutely got to read more. And so with the net worth of Americans rising by 7%, and all of a sudden we're at an all-time high, it's like, that's really, really counterintuitive in terms of where we currently are with regards to the pandemic, and knowing that there's unemployment and everything else that's going on. But it really comes down to, let's go ahead and break down what net worth actually means. Basic math, assets minus the liability. So what do I have in terms of cash? What do I have in terms of equity? And then subtract out all the things that I owe.
Thank you for keeping it simple for the anthropologist in the crowd, by the way. So I appreciate that.
No problem at all. Yeah, and so assets, it's pretty much the story that we've all been talking about for the past 6-7 months. And it's been on repeat. So government's pumping tons of dollars into the pockets of American families. We also have discretionary spending that is down, either because people are being cautious and or they have no place to go in order to spend it because of lockdown. But then you also have, for those fortunate Americans who have the ability to actually invest inside the stock market, many of the gains that we've seen in this year have helped contribute to their overall increase of assets. But what I find really interesting is the other side of the equation, liabilities, because that's really helping us understand the behaviors of American workers and what they're doing with regards to any of the debts that they actually owe. How am I going to pay it? Which ones am I going to pay? So there's a couple of things that I want to talk about here. One is going to be accommodations and how they're actually freeing up some of the choices that Americans have to make around the dinner table. Two is going to be your delinquencies. So how well are the American workers actually managing the payments of many of their lines of credit and debt? And then we also see that debt is trending downward and understanding why. And lastly, talking about the utilization of credit cards and where is that actually heading? Because all of those are going to roll into liabilities.
Yeah, so I'm looking at this, Zoey, and I'm still a bit befuddled, right? So people benefited from the CARES Act, spending flattened as people started to get a little bit worried and uncertainty set in. And then those who could invest, they did invest. But on the other side, I mean, debt's down, delinquencies are down. Did I see this right? Credit card utilization is down. I just feel like I must be missing something. So maybe I just don't understand the impact of accommodations, or maybe that's key. Can we explore that a little bit?
Yeah, absolutely. And so a lot of this sort of paints a rosy picture, but one of the other things that I really like for us to think about is, okay, let's go ahead and dig a little bit deeper and see where are the pockets of struggle, because we all know someone who is struggling. We all have seen it on TV, and some of us actually may be part of that struggle. And so really understanding the fact that there are things out there such as accommodations. And so what they're doing is allowing people to say, yeah, well, maybe for this credit card, I don't have to necessarily pay it for this month. And so the lender is actually being accommodating and allowing you to postpone some of those payments and maybe put it off for a later date. There's different ways in which accommodations are actually working. So you have forbearances on mortgages. And you also have auto lenders who are offering accommodations. And so even with this chart here on the left, we can see that accommodations for auto loans were around, say, 0.5% back pre-COVID. However, we started peaking around 7%. So we have like a 14x number of accounts that are under accommodations, which means that 14 times more the number of people who previously needed help with their auto loans and were going directly to the lenders and saying, hey, I need to go ahead and like put this off for a bit, and the lender agreeing to it. That's risen 14 times at this point. Now, it's dropped since then, but we're still at like 7x pre-COVID. So there's a lot that's really helping with being able to take care of some of the debt that's out there.
Yeah, it's interesting because at Salary Finance, one of our core products is a salary-linked unsecured personal loan. And I know that many of our clients were impacted early on by furloughs or, lost wages. And so we proactively gave payment holidays. So in some ways, my Italian mom would say that, do the right thing when nobody's looking. So in some ways, looks like that's what a lot of the financial institutions, including us, did, was give forbearances. That also complemented the CARES Act, right? But the other side of the chart is really interesting too, around student loans. I haven't seen a flat line like that for a long time.
Yeah, and so what this is showing is that, like the other accommodations, which are somewhere around between 1.5 and 7.9%, student loans, actually, given that many of them are actually backed by the government, been under accommodations for quite a while. So you have 49% pre-COVID that were under accommodations. Just think about all of the student loan struggles that have been out there. But since the CARES Act and really stepping up and saying, hey, let's go ahead and do something about all those who actually owe against the student loans, 91%, the vast majority of student loans are actually under accommodations at this point, and we're looking at extending that through the end of this year. So,
and what's an average student loan payment, Zoey?
So nationally, we're looking at about $270. Go ahead and call it $270. So there's now the question becomes, okay, well, what do I do with that additional money? That's just one. So $270 just for the student loans. Let's say you have an accommodation over your auto loan as well. Let's say that you also have it against one of your credit cards. So this is money that they're now able to redirect and figure out, well, how am I going to manage this pandemic? Maybe I didn't lose my job, but maybe my spouse did. That still hit the household. So how is the household going to manage this rearranging of the budget?
Yeah, I mean, what are people doing? I seem to actually be spending more since March, right? I joke with my Amazon friends, they're opening a distribution center a few miles from my house because I use them for everything. So I feel like my spend has actually gone up. But what are people doing with the extra $270 plus their unsecured personal loan plus their credit card? Do you see anything in the data around, I don't know, I would expect delinquencies to be impacted, because where am I paying down debt or am I spending more? What are you seeing?
So overall, what we're actually seeing is, people are paying down debt. And so if we take a look at delinquencies, you have a couple of things that are impacting delinquencies. One, we have the accommodations, we have the forbearances. So if I don't necessarily have to pay against a particular line of credit and I don't pay, well, that's not considered a delinquency if it's under accommodations. And so just by the nature of having accommodations, we can see across the board. So this chart here is just kind of some data eye candy, but at the end of the day, what we're really trying to show is that we have at different income ranges, 0 to 25K, all the way up to 150K plus, And then looking at different types of loans. So we have student loans, we have credit card loans, we have auto and mortgage. Across the board, you have the exact same shape at different flattening rates. But we can see very easily that for student loans, primarily because of forbearance or because of the accommodations, but also even for credit cards, we can see that we are definitely down in terms of delinquencies because of accommodations and the fact that people are taking that money that they don't necessarily have to pay towards X, they're putting it towards Y. Or maybe they are also putting it towards X, which is part of the reason why we start seeing things such as credit card utilization and credit balances going down.
Zoey, can we go back to that prior slide for just a second? Because first of all, you had me at data eye candy, right? So I'm a bit of a geeky nerd myself. But I also see that in some of those categories, it looks like maybe the tails are starting to creep up a little bit. I mean, in what categories do you think what's it going to look like for year end? And I mean, how do you think that's going to pan out? Are there certain ones where you think it's more likely that delinquencies will start to increase? Is that credit cards? Is it auto loans?
So if we think back to the previous slide, we basically had a curve that went like a bell with regards to accommodations. That's because lenders are starting to let off the gas with regards to accommodations. It's like, okay, at the end of the day, we are still businesses and we still do need to get paid, which means that as accommodations pull off, delinquencies will potentially start creeping up, theoretically. To your point, yes, there are some tails. If we look here at credit cards, we can see that it actually is rising slightly. Now, this is through July of this year, so it'll be really interesting to start seeing what it's going to look like for August, September, October, so on and so forth, as businesses start opening up. So
that's fascinating.
Potentially, people are putting more money against their cards because they're out and they're spending. But now accommodations are letting off, so maybe they are going to end up being delinquent on some cards as they start playing the shuffling game. So yeah, it's going to be very interesting over the course of the next couple months.
Do you think do you think credit card utilization is going to go up? What does it look like since March?
Sure. So as far as credit card utilization, what's really interesting is when you start breaking this down into things such as, say, industry, or breaking it down to hourly versus salaried. A lot of these things don't actually come about until you end up doing those breakdowns. So for instance, we talk about credit card utilization being down. Although it may be down, if we look at the credit card utilization change over time, basically month to month, as expected, January credit card utilization tends to go down. We end up going for a big burst inside of December for Christmas, and then all of a sudden it shoots down come January once the bill start becoming due. However, this year, we start seeing that inside of March, it actually started rising back up. And what's interesting is that if we look at hourly workers inside of food service, retail, food or drug stores, it actually starts going up. And what happened inside of those particular sectors? Well, you had massive layoffs, you had furloughs, a bunch of different things, and you also had everyone panicking during the pandemic. So some of this additional spend could be attributed to either one, they really just got to the point where it's like, oh no, I don't really have much in terms of savings. I'm an hourly worker inside of a relatively low wage industry. And so they're having to rely on their credit cards. But then there's also the other side of it of, we're panicking during a pandemic. Quick, I have the toilet paper. Quick, we need XYZ. So there's a lot of things that were actually happening during that time period that could cause some of these spikes that we're seeing here.
Yeah, it's fascinating too, because I think our data at Salary Finance really substantiates this. So the more vulnerable populations, they're relying on credit cards and alternative loans to get through their cash flow, right? So typically, as you said, we'll see it at the beginning of a school year, or we'll see it at the holiday time. And now it looks like we're seeing it in March, where cash flow might have been tightened with reductions in wages or potentially furloughs or family members and their impact. So I see a lot of that. But are there any areas where it's like concentrated? You said a minute ago about some of the essential workers. Are our most vulnerable populations living through their credit cards? Is that where we see the impact?
Unfortunately, the data is pointing there. So for instance, we go ahead and take that same data, the same metrics. Let's go ahead and look at it instead by age generation as opposed to hourly versus salary. Yeah. Even here, we can see that those within basically the younger age ranges, the percentage decrease change over month with regards to credit card utilization seems to be concentrated there as they're pulling back. Either one because of really just fear in terms of the pandemic and what are we going to do about, I can't really put anything on the credit card if I don't have anything to pay off the credit card with. So there's a lot of different things that come into play there. What I also found interesting about this particular chart, though, was some of the end months. So if we look at, say, June, July, we actually see some upticks that are actually occurring. So you got to remember that inside of June, July, a lot of businesses started opening back up slowly but surely. And so people are actually getting out. And we see this, once again, a lot more concentrated within the younger age groups as they are starting to move outside of the house and really become patrons of the businesses.
Yeah, so maybe that March was spring break and this is now summer break, a little bit of spend, right?
Yeah.
Zoey, what we're seeing is, though, if you look at the next slide, and maybe I'll put a little color commentary from the salary finance view of the world, is that we're seeing, oh, I'm sorry. Wow, what is this? Subprime credit scores. Oh, yeah, this is really great. Can you talk to us about this?
Yeah, absolutely. So in 2019, the average or the median income for an American worker was, call it $36,000.
Yeah.
So if we go ahead and we look within that age range, basically the $25,000 to $50,000 age range, we can see that 1 out of 3 actually have a subprime credit score. So basically a below 620 Vantage score 3, which means that they're going to have some issues and concerns with regards to securing additional credit, being able to help themselves when it gets to a point where, let's say, accommodations do start running out. Let's say that they are potentially still unemployed or maybe underemployed, who knows. But at the end of the day, being able to actually access credit when they need it most is going to be a huge concern throughout the rest of this year. Even if we look at, a level up, 50 to 75, you would think, okay, not bad, making a pretty decent living. But even those, we're looking at 1 out of 4 are actually holding subprime credit scores. So it's really an issue up and down the line.
Yeah, this is a place certainly where we at Salary Finance, and I'm sure a lot of the other fintechs at this conference are beginning to see opportunities to open those doors and open access to more affordable capital. We do it through, obviously, a salary link, which lets us be inclusive around lending and help these same folks that you're talking about here. But also, I've seen it as a much broader problem. So maybe in the next 5 minutes, I'll just share what we're seeing around financial resilience, particularly as it relates to savings. So yes, you spoke to the LMI population, and since COVID, about 34% of them have spent down their savings. But the number that I found most interesting in all of this is that 25% of your upper income earners, they're in trouble too. They can't go 3 months without borrowing. And some of our data is showing that 28% of your employees that make $168,000 a year are living paycheck to paycheck. So again, I'm sure that while we haven't separated it in your prior slide around subprime credit scores, that a slice of that is still these upper income wage earners who don't have access to credit and don't know where to go to get that and to solve that problem. So liquid savings, I think, is a huge one when it comes to resilience. And when you start looking at that, if you look at the next slide, you start looking at that from the perspective of groups that were hit the hardest. Hispanic Americans and African Americans were definitely hit the hardest. And as you see on this chart, neither group has 3 months of rainy day savings. And if you go to the next chart, you'll see that that's further complicated by the wealth gap where, average white Americans are at 171,000, and both of the more vulnerable groups are much less than that at 17 and 21,000. So access to capital, a widening wealth gap, job losses. If you look at the next slide, you'll see that, the concentrations of no savings, no risk, unbanked, underbanked, all tend to fall into our more vulnerable populations. And so what we're doing at Salary Finance is taking this as an opportunity to broaden access to affordable capital. So we work with employers to deliver much more credit, much more affordable credit through the workplace. So I think the only way we're actually going to be able to address some of the problems at scale that you're talking about is by partnering in the workplaces. And I know Equifax does that as well, with their financial reporting and their ability to create, financial snapshots, if you will, of the stress in an organization. There's lots of data too, Zoey. We don't have to go through now because I'd like to take a question, but anxiety is up by 23%, depression's up by 30%. I saw one statistic where that same population you're talking about of young workers and others, that 67% of them are worried about money. They have 37% worry every single day about money. So yeah. I think the challenge that we should put forth out of this and using the data for the rest of the afternoon is really, I think it's time to break all these taboos. I didn't grow up in a household that talked about money, and I certainly didn't talk about it in the workplace. So I think we should probably make it okay in the workplace to talk about the M words, whether that's, mental health or money health. I did a talk last week, Zoey, and afterwards a VP of HR hit me up on LinkedIn, and she said, I'm in trouble through a divorce, through all these other situations. I have a subprime credit score. I can't get access to credit. And I could never bring this up in the workplace because I would be viewed as incapable. So I think there's still a taboo that surrounds these conversations. I don't even think COVID, sadly, has opened up the doors to that discussion. But I do think we should start thinking about moving from thought leadership to action leadership and let data, I think data's sexy. So let data drive this discussion and maybe let compassion lead the change, but use data as the foundations. So I know we're up on time, but maybe there's a question or two. And if not, Zoey and I have our contact information, and we'd love to share the data we have. We have much more extensive data that's downloadable. So please reach out to us along the way, and we're happy to share with you. Zoey, thank you so much for the information. Thank you so much for helping us understand how COVID's bringing about financial well-being. And let's hope we cure the pandemic, but also let's hope that we can also get people to a place of financial well-being. So thank you, everybody, for joining us. And Zoey, I will see you later. Thank you again.
Thank you. Take care.
Bye-bye. Bye, everybody.